Hello everyone, thank you again for checking in for your weekly update. Some information on what's going on in the market, a little bit of a change of course lately. So following the Fed's move last week to combat inflation, we witnessed one of the most aggressive interest rate hikes seen since 1984, resulting in the first weekly decline the S&P has seen since March of 2020. Short-term interest rates are now expected to be around 3.5% by year end. And Americans are feeling the weight of this inflation. With all that's going on, it's difficult to feel optimistic about the state of the economy. This is evidenced by the deflated consumer confidence as families battle price increases, especially in the area of food, gas, retail spending. Spending has slowed down significantly during May. That means households are feeling the pinch. U.S. gross domestic product shrunk last quarter, and 2 contractions in a row typically indicates that we're on our way to a recession now. The Fed said it expects GDP growth to be 3.7% for each of the next 2 years, and GDP growth was 6.9% at the end of quarter 4 2021. Just to give you some comparison, we are declining here. It's increasingly more difficult to think a reduction in inflation can be achieved and still avoid a recession. We're not as optimistic as we used to be. The real question is, when will a recession occur and for how long? People are changing course now in their reviews concerning the economy, but still views vary widely, with some analysts believing mild recession starting in quarter 4 and others believing we are already in a recession. Those with a mild outlook believe that most low to middle income Americans are equipped to withstand a recession. That's because we've got enough cash saved. We kind of put a bit aside during the pandemic. We've got more equity in our homes. We're still spending, and there's sufficient jobs available as of now. The job market's still very tight. This is very different to 2008. Nonetheless, it's growth we're concerned about. Other financial professionals have painted a more dire picture, with Bank of America and Deutsche Bank leaning towards a full recession being imminent and will last longer as government stimulus is unlikely. Now we're trying to tighten the money supply, so it's unlikely as government's going to throw money at us as in 2008 and other difficult times. Just to quote somebody famous, Elon Musk recently mentioned that he believes the US is already in a recession that could last anywhere from a year to 18 months. He also said recessions are not necessarily a bad thing. He's been through many of them, and what tends to happen is when you have a boom, so much money for too long is thrown at, he considers it a misallocation of capital. What he means by that is when the last few years we've had nowhere to go but stocks. There's so much money in stocks and growth companies that caused those companies to be overpriced, and so now we need to get back in balance. If the experts are divided in their outlook, then the old phase, prepare for the worst and hope for the best, is probably the best position to take right now. It's a stand we're starting to take. We're going to prepare for the worst and assume we could see slow growth for a while, but we're going to hope for the best and hope that that can still be avoided somehow. What does seem to be clear, though, is the markets have had enough of government narrative, the government's narrative that the economy is strong and that there's nothing it can do about high energy prices. The markets have had enough of the spending and printing of money. So after assessing Chairman Powell's comments, the markets have concluded that the Fed was marching us straight into a recession, and it's apparent by another sell-off. That was last week. The last couple of days we've seen the markets come up a little bit, but still no long term. We're anticipating a rough ride, so we're also positioning ourselves for a rough ride. These daily gyrations can be very stressful, but we are still higher in the markets than we were 2 years ago. So we're still higher than we were when we came out of in 2020 around about COVID time. What will we be doing? Well, we're taking a bit more of a defensive position for the time being. there's still opportunities. There's always opportunities despite market changes, market turmoil. There's always somewhere to go. Right now, as I said before, we're seeing stocks move from growth companies into companies with more stable earnings. A dividend paying strategy is usually a good one for times like this. Companies with strong, consistent history of paying dividends is somewhere to go. We call this being paid while you wait. Another strategy, as we've mentioned before, is our US Unique Possibilities portfolios, where the money managers are looking for current opportunities. Infrastructure, for one. Anything that does well in a high inflationary environment is somewhere to go. Commodities have been a place to go, although a little bit riskier than most other asset classes. Another one we're starting to look at is the possibility of covered call options. If you've got cash on hand, you can consider, I know it seems like an oxymoron, but if you are sitting on cash, it may be a good time to start heading into the market, with dollar cost averaging in always being a better strategy over time, over the long period of time. Roth conversions, that's another thing to consider at this time. It's a good time to, if you've been thinking about a Roth conversion while your IRA value is down, how about shifting that into a Roth environment? When it rebounds and there's a comeback, it grows in a tax-free environment. These are all things to consider, opportunities you can consider at this time. Again, as I say each time, if you are concerned about anything, want to have a quick chat or review anything that's going through your mind, or want to take a look together at how your plan's doing, just give us a quick call and we'll arrange some time to talk and answer your questions. You can schedule online through the LifeWealthGroup.com. Call us at 407-299-4129. Also, take a quick look at our check-in for emails and upcoming events coming out, and see if there's anything there that might be of interest to you. But as I've said, please give us a call. Tell your friends to give us a call if they've had concerns. This is not our first downturn in the market. We've been through this before. It's not our first rodeo. There's opportunities if you know how to pivot. So thanks for listening in. Listen out for more emails from us.